What's up, everybody? It's Abbas, and welcome back to the channel. Today we're talking about something that can completely change your financial life: putting your money to work. Because let's be honest, working for your money is so 20th century, right? We're going to be diving deep into smart ways to save more money and then put it to work by earning interest. Whether you're just starting out or you've been hustling for a while and want to see your money grow faster, this video is for you. We're covering everything from simple budgeting strategies to different investment options, all designed to help you reach your financial goals faster. So grab your notebooks, get comfy, and let's get right into it. All right, before we even talk about investments or fancy financial products, we need to address the foundation of it all: budgeting. Think of your budget as your financial roadmap. It helps you track where your money is going and make conscious decisions about your spending. The first step is to figure out exactly how much money you're bringing in each month. Next, track your expenses. Write down every single thing you spend money on for a month, from that daily latte to your rent payment. Now comes the fun part: identifying areas where you can cut back. Maybe it's eating out a little less, finding a cheaper phone plan, or canceling that subscription service you barely even use. Once you have a handle on your spending, you can start setting realistic savings goals. A good rule of thumb is to follow the 50/30/20 budgeting method. By taking control of your finances through budgeting, you'll be amazed at how much faster you can reach your savings goals and start earning real interest on your hard-earned cash. Now that you've got a budget in place and you're starting to stack some cash, it's time to talk about building an emergency fund. This, my friends, is your financial safety net, your OSHI*T fund for when life throws you a curveball. Think about it. Your car could break down, you could lose your job, or you could have an unexpected medical bill. So, how much should you have in your emergency fund? A good starting point is 3 to 6 months worth of living expenses. Where should you keep your emergency fund? You want it to be easily accessible, so a high-yield savings account is a great option. The key is to have it separate from your everyday spending money so you're not tempted to touch it. Building an emergency fund might take some time, but it's one of the smartest financial moves you can make. It gives you peace of mind knowing that you can handle whatever life throws your way without derailing your financial progress. Okay, let's talk about making your money work harder for you. If you're keeping your emergency fund or any other savings in a traditional savings account at a big bank, you're missing out, plain and simple. Those accounts typically offer pitiful interest rates, sometimes as low as 0.01%. Enter high-yield savings accounts. These bad boys offer significantly higher interest rates than traditional savings accounts, meaning your money will actually grow over time. We're talking 10 times, 20 times, even 50 times higher interest rates. It's a no-brainer. High-yield savings accounts are just as safe and FDIC insured as traditional savings accounts, so you don't have to worry about sacrificing security for higher returns. You can access your money whenever you need it, making them perfect for emergency funds and short-term savings goals. So do yourself a favor and ditch those low-yield accounts. Shop around, compare rates from different online banks and credit unions, and find a high-yield savings account that works for you. Got your emergency fund? Great. Now consider certificates of deposit or CDs for higher interest rates. CDs are time deposits where you lend money to a bank for a fixed term. In return, you get a higher fixed interest rate. But beware of penalties for early withdrawal, ideal for long-term goals like a house down payment. Chapter 5. Bonds: lending money like a Wall Street boss. All right, let's step it up a notch and talk about bonds. Essentially, when you buy a bond, you're lending money to a government or a corporation. Think of it like giving someone a loan, and in return, they promise to pay you back the principal amount plus interest over a set period of time. There are different types of bonds, each with its own risk and reward profile. You've got government bonds, considered the safest option because they're backed by, well, the government. Then there are corporate bonds, issued by companies, which typically offer higher returns but also come with slightly higher risk. Now, bonds might not offer the same potential for sky-high returns as, say, the stock market, but they can provide a steady stream of income and are generally considered less volatile than stocks, making them a good addition to a diversified portfolio. When investing in bonds, it's important to consider factors like interest rate risk, credit risk, and inflation risk. By doing your research, understanding the different types of bonds, and diversifying your bond holdings, you can mitigate these risks and make bonds a valuable part of your overall investment strategy. Chapter 6. Stock Market Investing. Grow your wealth like never before. Okay, everyone, it's time to talk about the big leagues, the stock market. Now, I know what you might be thinking. The stock market? That's risky. That's for Wall Street guys in fancy suits. But trust me, the stock market is a powerful tool for building long-term wealth. When you invest, you're buying a small piece of a company. As the company grows, your shares increase in value. Of course, there's risk. The stock market can be volatile, but historically it trends upwards, building significant wealth over time. Chapter 7. Peer-to-peer lending. Be the bank, earn higher returns. All right, let's wrap things up with a slightly more unconventional investment option, peer-to-peer lending, or P2P lending. This is where things get interesting because you're essentially cutting out the middleman, the big banks, and lending money directly to borrowers. Platforms like Lending Club and Prosper connect borrowers with investors, allowing you to browse through loan listings, assess risk levels, and choose which loans you want to fund. You can diversify your investments across multiple loans to mitigate risk. The main draw of P2P lending is the potential for higher returns compared to traditional savings accounts or even CDs. Since you're lending directly to borrowers, you can often earn interest rates that are significantly higher. However, it's important to remember that with higher potential returns come higher risks. That's why it's crucial to do your due diligence, carefully evaluate each loan, and diversify your investments across multiple borrowers. Outro. Start earning more on your savings today. There you have it, guys. We've covered a ton of ground today, from basic budgeting to different investment options, all designed to help you save more money and make your money work harder for you. Remember, building wealth takes time and effort, but by implementing these strategies and staying consistent, you'll be well on your way to achieving your financial goals. If you found this video helpful, don't forget to smash that like button, subscribe to the channel for more finance tips, and hit the notification bell so you never miss an update. And let me know in the comments down below what your biggest takeaway was and how you plan to start saving and earning more interest today. Thanks for watching, and I'll catch you in the next one.